We had a big surprise from the Bank of Canada today, a rate cut, and not many people saw this coming. Here to tell us what this means and what it could mean moving forward, we're joined by Sean Osborne. He is Chief FX Strategist at TD Securities. It is nice to see you today. What did the Bank of Canada see that no one else really seems to see in terms of concerns about the economy?
I think the message from the bank was that lower oil prices are going to hurt the Canadian economy. We knew that there would be an economic impact from the decline in oil prices. But I think the message from the bank today with this move is that this may be quite a significant blow for the economy moving forward, and particularly the oil patch, which is reeling really from the decline in oil prices that we've seen over the past few months.
It's interesting because if we look at what the market reaction was today, equities, we saw a bit of a rally, and just myself, I was thinking, if the Bank of Canada governor is saying that he has a concern, I had almost the opposite reaction. What's your reaction? I mean, you're saying he sees problems with the oil price drop. Can you kind of, this is giving you a little insight into where perhaps he's thinking?
Well, I think we have to remember that, the oil patch and the prairie provinces have really been doing a lot of the heavy lifting for the Canadian economy over the last few years. When we look at employment growth, house price appreciation, what wage growth we have seen in Canada, a lot of that has been centered around the activity and the growth that we've seen in Alberta and that part of the world. A good chunk of the employment growth we've seen over the last few years has really been driven by the oil patch. So significant issues or problems, headwinds for that part of the world are going to fairly quickly spread out into the rest of the Canadian economy, as we've already seen some evidence that with the data we had this week, manufacturing sales for Canada in November were down much more than the market expected, down 1.2% in the month, which suggests that activity generally in the latter part of last year, at the very least, is going to take a pretty significant hit. And we already know, as we've seen moving into January, that oil prices have not recovered. So I think this is a message from the bank that growth and inflationary pressures are going to stay very, very subdued. I think people were kind of on side with that view anyway. We knew that the economy would probably not grow quite as quickly as had been expected, and that the inflationary pressures would diminish just on the back of the impact from energy prices. But what the bank seems to be saying is that we need to take out some insurance here against the risk of a broader slowdown.
Is the insurance also, I guess, broader slowdown in Canada, but also against oil prices themselves? I mean, people are seeing, we're low, we see some sort of rebound. Do you think the Bank of Canada has a different interpretation, perhaps, of where oil prices are going?
I don't know. I think the bank just has to react to where the market takes oil prices. We can't really control here in Canada what oil prices do. We have to react to either high oil prices or low oil prices. And I think what we're seeing right now is a reaction to very low oil prices, and the risk perhaps that oil prices stay low or go maybe a little bit lower in the course of the next few months. Let's
talk about the bank's mandate is not to manage the currency officially, but clearly the currency reacted today, dropping more than a cent, trading below 81 cents. What does this say for you in terms of where you think the currency might be going?
Well, I don't think, first and foremost, I'd say that the bank is not specifically targeting the exchange rate. The currency was already falling. We'd already had a pretty significant decline in the Canadian dollar over the past few months, just on the back of oil prices and weaker commodities generally. So the Canadian dollar was already doing its job of absorbing the shock of that shock from low oil prices. So I don't think the bank's decision was primarily focused on the exchange rate or was looking to give the exchange rate another nudge lower. The Canadian dollar was weakening and doing a pretty good job of providing at least some sort of offset to this shock to the domestic economy. But nevertheless, the move was a surprise. I think most people, the majority of market participants, thought at the very least the Bank of Canada would stay on the sidelines for the next few quarters and that interest rates would stay low. I don't think many people thought that they would cut rates. We did. I would say, however, we did have perhaps a bit of an indication of the way the bank was leaning last week with Deputy Governor Lane's comments, which may be a bit of a new departure for the Bank of Canada watchers. We're pretty used to deputy governors not really talking much beyond the remit
taking a page from the Fed, perhaps?
Yeah, so that may be a bit of a new wrinkle here, where we start to see the thinking behind the decision making being a bit more transparent. So I definitely think, and actually Governor Poloz referred to Deputy Governor Lane's comments in his remarks today. So I definitely think there's a bit of a heads up here. That the old days of the deputy governors really just reading from the NPR and not really offering any new insights or deviating beyond the sort of core message from the bank is past us, and we're going to have to pay a bit more attention to this going forward.
You and I were chatting before we started, and I think you brought up a really interesting point. And moving forward, for people who are watching, we've got a situation right now where the Bank of Canada has made a move, and it is diametrically opposed to what the Fed is doing south of the border. What does that mean?
It's a very interesting point. It's very, very rare to see even the hint of a big divergence in monetary policy between the Fed and the Bank of Canada. But this might be a situation we're looking at in the next few months. We still think the Fed tightens interest rates in the second half of the year, maybe towards the end of the year. But before that, there is already a fairly significant head of steam building up behind expectations that the Bank of Canada could cut rates once more later in the spring. The theory that there's never just one cockroach, I think, is really driving expectations that the bank is unlikely just to go once. If this is an insurance move, as they're portraying it, they may need to take out a little bit more insurance. So the message for the currency is that interest rate differentials, which are a pretty big part of what drives currencies going forward, are likely to move against the Canadian dollar in a fairly significant way.
That means more downward pressure on
more downward pressure on the currency. So we're in a situation where the Fed is trying to normalize monetary policy, get away from QE. We know the QE program is ended, and we're thinking about, certainly the Fed messaging is that they're still thinking about raising rates in the second half of the year. So interest rates, short-term rates in the US are likely to move up. Interest rates in Canada, maybe a little bit before that, not around the same time necessarily, but interest rates ahead of that are going to be moving in the opposite direction. So that's a pretty significant change of gears, I think, for what is going to be driving the Canadian dollar. We've already seen, as we mentioned earlier, a very significant decline in the currency already this year. But to my mind, we're not at the floor yet. In that situation, I would expect maybe another 3, 4, 5, maybe something like that, 5 cents off the exchange rate from here.
Well, I expect we're going to be talking a bit more in the next little while. It was a real pleasure having you here. Thanks so much.
Thank you.
Sean Osborne, he is Chief FX Strategist with TD Securities. I'm Kim Parley. Thanks for watching.